I'm Audrey Boyce with my co-host Kevin Casey, and today we are joined by none other than Dan Habib with MBS Highway. Hi, Dan. How are you?
Hey guys, doing good.
God, it's so good to see your face. Oh my goodness. All right, just a few reminders before we get it going. Number one, we are part of the Chrisman Media lineup. So, Chrisman Commentary, make sure you're checking it out along with the other videos or podcasts or shows or whatever we're calling them that are on their or in their lineup. Wow, I'm really doing this great, huh, Kevin? What do you think?
Yeah, you're doing really well.
Yeah, right. Okay, stumbling right along. We are doing live NMLS classes, and we've got a few of them. We just did one in Sausalito. Holy guacamole, was that a gorgeous, gorgeous day?
And it's sold out. That was the best part.
Oh, it was. I know people showing up in person to do continuing ed. Imagine such a thing. So next on the Freedom Train, we're going to do one in Fresno. There's one in Westlake Village. Wait, is that no? Is it Westlake Village or
Yeah,
West?
was like
By the way,
yeah.
Sausalito, there's a place there I used to go with my dad all the time. I'm not sure if you're familiar. It's called Skoma's.
Oh
Oh,
God,
yeah,
yeah,
yeah.
yes, yes, yes.
I love that place. Anyway,
Yes,
continue. Sorry.
yes, yes. I mean, let me tell you, I was back there on Thursday for one of my son's birthdays, and it's just glorious. It's so
Right on the water there.
beautiful.
It's nice.
Right on the water,
Yeah.
gorgeous view of San
Love
Francisco.
it there. Love it
Yeah.
Oh,
there.
the food is amazing. It's just
Speak.
fantastic. So again, we do continuing ed there every year.
Sounds
Hello.
like a great
I mean, how
spot
much
for
are
it.
we? I know it's great. So okay, so
And the best part is we get the room for free.
hey, just pipe down. Okay.
So it supports the local California Association of Mortgage. They make a good chunk of change from that show. So that's good. And then speaking of being on the water, I was supposed to teach a class next week in, of all places, Asheville, North Carolina, that just got wiped out by the hurricane.
Okay, Kevin, you are getting
Yes.
out. You're out of order. Okay,
Oh,
I
sorry.
did a
Sorry.
piece with NMLS, and trust me, Hurricane Helene is on my list, which is god awful. Okay, let's just wrap this up, shall we? Fresno, Westlake, which is down south in Ventura County, Martinez, California, which is in the Bay Area, and we're working on one in Silicon Valley. So if you are interested in live classes, email me, Audrey at mortgagepros411.com, and I will hook you
And
up.
if you have a group of more than 15 people and Open Does coming in, we'll go there.
Yes. Okay, so back to Hurricane Helene, which good God, what a nightmare. I mean, I am so sorry for everyone involved and anyone who's impacted. It is rough to watch, and I can't even imagine what they are experiencing. So our heart just really goes out to everyone.
Boy, some of
And
those videos from Virginia were crazy.
I can't even
Yeah.
watch
Houses
them.
floating away. Oh,
I know. And to Kevin's point, he was supposed to be there next week teaching
Yeah,
NMLS.
on Wednesday.
We have to cancel the classes. So it is rough. I do want to say though, Steve Jacobson, who I don't know actually with Fairway,
I know
they
why.
donated $1 million to the cause, and he called on other IMB owners to do the same. And I hope that the mortgage industry really steps up and actually helps in this disaster, because we have gotten so much as an industry, and it is really important that we give back. And especially, for anyone driving an airplane to go meet their friend for dinner at night, um, throw some money at this and help these people out. Okay. I mean,
Yeah.
really.
I have a good friend I was talking to last weekend who had a house burned down in Sonoma back with 2, 3 years ago when the fires were there, and still hasn't rebuilt. Has all the plans ready to go, and the city's holding them up on just a little tiny thing. But it's kind of like, wow, it's still, after all these years, still hasn't got his house back.
Well, we certainly have endured our own set of disasters in the Bay Area and in California. And we know that it can take years I knew people who lived in the Lafayette Park Hotel for 2 years after the Oakland Hills fire. So anyway, our hearts really are with everyone, and just do something to help with that situation. All right, moving right along. We have so much to talk about. There's so much going on in the economy. It's ridiculous. Just a reminder, it is jobs weeks, kids. So we had JOLTS today, we have ADP tomorrow, and we have BLS on Friday. So let's just start at the very beginning, Dan, like a nice Sound of Music song. Today we had JOLTS, job openings and labor turnover. Tell us how that went.
Yeah, so there's so much going on right now
So much.
in addition to the economic data, but like
I know.
the strikes at the ports,
Oh,
which
it's on my list, baby. Don't
oh, okay.
worry.
I won't jump ahead like Kevin did then. All right,
I know.
so
We've got keep it
so let's
together.
start with jolts, right?
Okay.
So the headline number looked like it was a little bit of a stronger report, and this is the main headline number here is how many job openings there are in the U.S. This is for the month of August. Last reading was around 7.7 million. They were expecting it to kind of remain there. It did increase roughly 300,000 to 8 million. So that looked like a little bit of a beat. However, in my opinion, this report, it's tough to compare to like previous times because the landscape's different. Yeah, I think job openings are being significantly overstated because now think about it, you have a company with work from anywhere, you could do a job posting in theoretically every state. It's still the same one job, but because you can now attract workers from every state and they collect these on a statewide basis, then you're counting that same job 50 times, right? It's hard to put a number on how much that's happening, but I know it is happening. Now, either way, directionally, this moved up a little, but then the internals were very weak. One of the main focal points in this report is called the hiring rate. That fell from 3.5% to 3.3%. And boy, that's the lowest level in over 10 years when you remove the temporary blip in COVID there. And then there's also something called the quits rate. Quits rate shows you the percentage of people like quitting their jobs. And a lot of times this is showing if it's a higher quit rate, that usually shows strength in the labor market because you're getting attracted from competition. You feel confident you can get another job. When this is going lower, it's a signal of weakness in the labor market. And it's been declining, but it just fell to 1.9%. That's the lowest level since 2015 when you remove COVID. So both of these moving lower. And when you see that happen, it has led directionally, like when you see this decelerating, to recessions previously. We actually shared a chart of that on the MBS Highway update video this morning. So I thought that overall, thought it was a weaker report.
Okay, but Uncle Jerome keeps telling us that the job market is solid and that the overall market is strong. So how do we reconcile what Jerome Powell is saying with what we're seeing in the numbers?
Well, since we last spoke, a lot has happened, right? So the
Yes,
Fed
it
cut
has.
50 basis points and they had the option to do 25, but they went with the bigger cut to front load this. They said this was their way of not falling behind with the market. But I think it does show a little bit of concern there, right? I mean, the Fed likes to be kind of cautious and patient and do things at a
Right.
more measured pace. So he tried his best to say the economy was still solid and not have it be a concern as to why they went 50. But listen, he just spoke this week. His tone on the labor market was a little bit different. He spoke yesterday. Bond market didn't love it
Right.
because he seemed to be more optimistic on the labor market. We'll get some big jobs data on Friday with the BLS jobs report, and we'll know some more. But it has been weakening. I mean, we're up 0.8% from the cycle low, which was back last year around like April. So, if you look historically, when you see that amount of change, it's usually preceded recessions. We had something called the SOM rule that was hit, where you have like the 3-month average of the unemployment rate 0.5% above the 3-month average low over the last 12 months. That was hit, which almost always confirms you're in a recession. But listen, think this time could be different. But I think they were certainly worried about the unemployment rate and the labor market side of their dual mandate, and that's why they cut. But even Powell's saying, listen, we're going to cut another 50 basis points this year. That's their base case, right? So that would mean a 25 basis point cut at the November 7th meeting and then another 25 basis point cut at the December 18th meeting. Although, the market doesn't necessarily fully buy it because if you look real time at the Fed futures, market's pricing in almost a 40% chance of a 50 basis point cut. But that's where it stands as of right now.
Yeah, but I want to remind everyone that the Fed futures the week before
The
the
week before.
meeting were definitely not pricing in 50 basis
No, it
points.
was like 15% chance the week before.
Yeah.
And then
So,
right before the meeting, it was like 50-50. But yeah,
yeah,
it was
that's
all
going
over
to
the
get
place.
up on a dime, right? So
Hmm.
it's
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 usually not very accurate going out, but like usually like right before the meeting, there's it's pretty accurate. But this one was actually the first in a while where there was a lot of uncertainty right ahead of it.
so in the 24 hours leading up to the meeting, we will be fairly certain about what they're going to do.
Most likely, we'll see.
Most likely.
A lot of times you get like a telegraph from the Fed mole, which is thought to be Nick Timiraos. He's a writer
Right.
for the Wall
Yep.
Street Journal. Yeah, a lot of
Yep.
times
We've talked
Fed.
about him.
Yeah, so a lot of times, different Fed, groups, they like to have somebody to kind of break the news to the market as to not surprise them. The Fed is kind of all about transparency nowadays, but um, he didn't give anything, I think, committal necessarily in this last one. If you read between the lines, I thought it looked like the markets took it as 50 because like he kind of ended on a quote in favor of it, but it
Right.
wasn't as black and white as I've seen in the past.
Right. I was trying to think, I was trying to figure out whether if I said pretty please really nicely, you think I could get him to come on here? What do you think?
I doubt it.
I
Although
doubt
I
it.
did get a chance to meet him
You did?
At the Economic Club of Washington D.C. a couple months back. It was funny. I don't think you're really supposed to go up to him, but I just kind of barreled in there, act like
Good for
like
you.
I knew
Good for
him.
you,
And
Dan.
I took some cool pictures with him. I tried to tell him, listen, I didn't have too much time. I was like, I think you should cut at the July meeting. He didn't listen, but I think they probably wish that they did now because they had to kind of catch up and do 50 at the September. But um,
Yeah. Well, he'll never
it
admit
was
it.
cool to see him though.
Wait, did you see Nick Timrose or Jerome Powell?
No, Jerome Powell.
Yeah, yeah.
Oh,
Okay.
wow. That's the one I want to have on our show.
Oh, you
Oh
were
my,
saying if you can get Nick Timiraos on here. Oh,
yeah. Yeah. I think it's unlikely Uncle Jerome's gonna come spend some time with me. I don't know why. Just like every time I go to the UK, I would think that the Queen would want to have tea with me, and she never did. Very confusing. All
well,
right.
as Jason is mentioning though, Uncle Jerome, his comments yesterday, they were not received well from the bond market because he did have a more optimistic tone on the labor front. Now,
Right.
I think it's supposed to be where the Fed chair gets a 24-hour sneak peek on the jobs data before it's released, which for the BLS jobs report, that would be Thursday. And,
Mhm.
yesterday he spoke was Monday, right? So he shouldn't have access to it. So, some people are like thinking, well, maybe he knows something about the jobs data that we don't yet. Certainly in the realm of possibilities. But as of now, the jobs data tomorrow kicking off with ADP is expected to show around 120,000 job creations for the month of September. And then on Friday, the big BLS one, that one's most important, is expected to show 140,000 jobs. And the difference there is government jobs.
Dan, can we just speak for a moment? Okay, first of all, just to make sure we wrap that up with a bow, unemployment rate should stay at 4.2%. We'll see.
That is the expectations.
The
But I
ex
will share this with you.
Yes,
So, if you remember 2 months ago, the unemployment rate shot up to 4.3%. And then in the last report, it came down to 4.2%. And I even saw people like the most hawkish Fed member, Fed Governor Bowman. She came out and she was like, "Well, she still thinks that inflation's not necessarily behind us. She's out there on an island
yeah,
by
big
herself,
time.
right?
Yeah.
She was the lone dissenter. She wanted 25 instead of 50 basis points, right? Everybody else voted for 50,
Right,
but she showed a little bit, in my opinion, at least, in my humble opinion, of like her lack of knowledge on some of this material because she talked about inflation being a problem because of housing prices and a lack of supply. Housing prices aren't included in the inflation reports.
right,
It's actually like housing services, it's how much rent is and things like that. So,
Mhm.
not really showing the understanding there. But then on the unemployment rate, she talked about how the unemployment rate bounced up from down, I should say, from four
Yeah.
three to 4.2. But if you take it out to like the decimal,
yes,
here's what really happened. It was 4.25 2 months ago, which got rounded to 4.3. Then it declined by 0.03% to 4.22, and it got rounded to 4.2. But there was really not much of an
The
improvement there
rounding
in
error.
the unemployment rate. It was a rounding error, but a lot of people make a big deal about that 1/10 move. But in reality, it wasn't a lot more strength than we saw previously. Now, in this report, it's expected to stay at 4.2, but keep in mind that with the rounding there, even if you see a little increase, it could go back up to 4.3.
well, and let's also talk for a moment about the breakdown of where the jobs are. Full-time versus part-time versus how many people have 77 jobs because they're trying to pay their bills and they
Yeah.
can't with just one. So, I mean, that's a big part of this that they don't discuss much.
Yeah,
I
the household the jobs report, it treats the part-time job the same as a
Mhm.
full-time job,
Right,
at least in the U3, which is the one that is cited everywhere as the unemployment rate, right? And that's the one that's at 4.2%. Something that I think is a better representation of the real unemployment rate is the U6. And what this does is adds back a lot of people that they don't count that are still breathing, are still citizens here and are still unemployed. So that number is much, much, much higher. It's like, 8%, right? So this figure adds back and counts the people that are part-time, but they really want a full-time job, but they can only find part-time work. They count them in the unemployed ranks and in the labor force. But then also, if you are disgruntled, it's say you're not working and you said, you know what? I'm not going to look for a job anymore. So over the last 4 weeks, you don't look for a job, they don't count you. It's like, well, you're still
Yeah.
unemployed. What? Oh, because they're not actively looking, we're just going to say you're not in the labor force and you're not in the unemployed ranks. It's no wonder why the U3, the one everybody cites, is much lower than the U6, which I think is like more reflective of what your real unemployment rate is. And that one continues to go up while the U3 went down slightly in this past jobs report.
I would just like to have a little chat with the genius who thought that U6 was to be ignored and U3 should be our focus, because that makes a lot of sense. All
Well, I
right.
think it fits the narrative better,
Yeah, exactly, exactly. Did they just bring you your lunch? What is that?
Oh no, my wonderful assistant brought me a little espresso shot to keep me going here.
Keep it going.
She's
Dragging this morning.
I like my espresso,
Okay,
So,
so you mentioned disgruntled, and it was a toss-up for me whether we're going to go next to the Middle East or the international longshoremen. But
oh
since
boy.
disgruntled was the word that popped into stood out for me, let's have a little chat about what's going on with this strike and with Harold Daggett, who,
Boy.
good God, I mean, this guy, first of all, he clearly understands supply chains, but making a comment, I will cripple you.
Yes.
What the? I
You know
mean,
what's funny? We did a lot of research on Harold, and
yeah.
believe it or not, and I don't know
He
if
off
this
his
is one
meds? What's
one.
going on,
I don't
Dan?
know if this is 100% true, but if you look it up, you'll find stuff on this that it says that he has ties to one of the mafia crime families and stuff. Like the guy's a no BS guy, I guess. But
Wait,
this
wait. First
strike,
of all, he sounds like he's in the mafia.
yeah,
Just when you
yeah.
listen to him
But
talking.
this strike, I think it could be really negative, at least temporarily, for our economy. So you have the ILA, as you mentioned, right? This is the largest union in North America, and it's most of the ports on the East Coast. Represents about 50% of the imports we get to the United States, and it's all the workers that load and unload stuff at the ports. So when you shut that down, it's almost like what happened with COVID, where you had like a line of ships out there
Yep.
that couldn't come and drop stuff off or couldn't load it, and
But they've solved that problem, Dan. You know what they do now? They put the line of ships outside past the horizon so you can't see them now.
Oh. So obviously it can have implications on the supply chains, right?
Right.
And it really, I think, matters how long that this goes on for. Now, the White House heard about it, and we're not going to get political here or anything, but their official statement was that they don't think it's going to have that big of an impact, and they're not doing anything about it. Right now, they have an option to enact this like Taft-Hartley act,
Uh-huh.
which has been not used often, but it's been used. I think Reagan used it, right, to kind of
Yep.
stop some of the strikes occurring, and it causes them to come back to work for like 80 to 90 days while negotiations are being made. But it seems like they have no interest in doing that. Listen, probably wouldn't be good, from election time period to do something like that either, right? For them because they're supposed to be pro-union. So, anyways,
Well, I mean, okay, there's so many things in my opinion. First of all, consult the calendar and tell me what is happening in 88 days. Let's start there, right? So, I mean, so you send these guys back, and if we're listening to Uncle Howard, okay, everyone's the uncle today. I don't know why. Anyway, if we're looking, oh, Harold, sorry, sorry, Harold, don't want to piss him off. If you're listening to him, they're going to come back if forced to by Taft-Hartley, and they're going to work at, maybe a quarter speed.
yeah,
And so the productivity levels are going to plunge, and then it's Christmas time. I mean, and his description of how
yes.
he's gonna like string this out and torture everyone it was chilling to listen to.
Yeah, it
And
was interesting to see, the White House saying that they don't think it's going to have a big impact, at least now. But then he had a completely different story. And obviously, each are probably talking their book a little bit, right? But I tend to agree with what he's saying because of how important what they do is. Where, hey, the first week you're going to see, well, now you can't get cars. These people are going to be laid off, or you can't
yeah,
get these supplies. These people, I mean, it could, if it goes on for a long period of time, it can be disastrous. And
right.
it's estimated to cost the U.S. in economic activity $6 billion a day. And it's got bad implications for inflation. So you haven't heard the Fed talk about this yet, but like they got to be like sitting there like, geez, like, we've been working so hard. We hiked rates. We think we've curbed inflation. They think they're in this Goldilocks position now, if you listen to Powell, thinking we can get inflation continuing to fall to their goal, keep the economy in a decent place, not cause the unemployment rate to go too high. They think they're going to get their Goldilocks soft landing. But this could certainly be a fly in the ointment if it goes on for a while, because it could cripple supply chains. It could cause inflation to rise again. If it's
Yeah.
only a brief period of time, probably not going to be that bad. But they're not right now scheduled to have any negotiation talks at the table. So it's a little bit frightening and worrisome, in my opinion.
And
And
they
do
want
we
a 75% pay increase.
Yeah, I mean, that's pretty substantial.
That's
wait,
like,
what
wow.
did you say 75?
75, yeah. They were offered 55.
Yeah, I mean, listen,
Yeah. Would you
I'm
turn
not,
down a 55% pay increase? I mean,
I
it's
don't
only
know
like
too
5
much
years
about it.
of that, but
I don't know too much about like their pay and if we're being fairly or unfairly fairly
the
paid
issue
for.
is they
But
don't
like,
want automation. That's what
but
they don't want.
but
Oh, okay.
55% sounds like,
Yeah, you
pretty
know what?
good.
We should bring back those guys who manually lit the street lights every night too. What a good idea. I
Well,
mean,
we could bring back the guys who go onto the ships and take the sacks off the ships. That would be, going
oh
way
my
back.
God. Okay, this is okay. I don't even
But
want.
it does seem like the world's crown. I mean, you got this, which we just talked about a bit, right? So we gotta hope that ends soon. So otherwise, it could be bad ultimately for what everybody here cares about: inflation and mortgage rates.
Yeah.
Could be a
And by
bad.
the way,
Um,
longshoremen, great clients. They make buco bucks.
mhm. I heard that I mean, I have some friends that work at the ports,
Yeah.
on the West Coast, and like, his opinion on it was that they were being pretty greedy. He's like, a lot of them were paid very, very generously, and
Yes.
they
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 make
think
good
and
money.
they saw
That
an opportunity
okay,
here to really get them by the.
that's the messaging we need to, everyone needs to understand what they're asking for versus what they were offered. And by the way, you want to impact inflation, the Fed should be worried no matter what. Because if you've got the largest union in the country demanding 75% wage increases and they've turning down 55%, they already made a ton of money. What the hell? Oh
Mhm.
my God. Okay, we just went from bad to worse. Let's talk.
And then, boy, I was just watching the TV before.
Oh,
You got the Iran firing all
I
kinds of
was just
missiles
about
to,
to, I'm like, speaking
Israel.
of,
I
yeah.
mean, it's
I'm
like
glad
the
I was
world.
watching.
You got Russia, Ukraine. You got China wanting to invade Taiwan. I mean, it's like, what's going on with the world right now?
Everyone has lost their damn minds, but I'm gonna say that the this is the kind of thing. Do you remember when we thought, okay, May 10th or 11th or whatever day was the magic day that we're gonna have better
Oh
rates,
yeah, with inflation,
800 years
sure.
ago, and then all
Mhm.
of a sudden you have a bank failure and you have Russia invading Ukraine.
A lot of supply
There,
of bonds and treasuries coming to market too, which was unexpected.
but
And
my point is, you just you can't guess these things and not know
Oh,
what else is going to come out of left field, which actually, okay, so let's talk about this situation right now between Israel and Iran and what that potentially could mean for us as far as trickling down into our economy and mortgages. What are your thoughts on that? Are there any issues we should be aware of?
there's not necessarily like a direct impact, but like
Right,
depending
never
on, I
is.
mean, but listen, like I mean, I heard that the U.S. moved like an additional aircraft carrier, 40,000 troops. Like we're obviously monitoring the scenario very closely. So,
We have
it could
40,000.
cost us dollars for sure. And I don't want to sound insensitive, so like the whole issue is terrible, but could cost us dollars. Maybe that has to be, funded through treasuries and stuff. But also, historically speaking, when you have like war or things like that, there is or can be what's called a flight to safety,
yeah.
which means that normally you see like risk on assets, like let's say stocks. Money comes out of that and it goes into the safe haven trade of the bond market. So, in a counterintuitive or silver lining type
So push
way,
rates down.
sometimes you could see that help mortgage rates or the
Yeah.
bond market and yields and rates. But obviously, we'd rather, none of that ever happens. But
Please, please. Okay, so we have a comment here from Jenny who said she thought that the 75% increase was over the next 6 years. And I mean, honestly, like, even if it is over the next 6 years, isn't that a ton? Holy moly. And just to be clear, I think all of our politicians are terrible. So I'm not one-sided. I'm no-sided. So
well,
I'm not favorite one over the other. Trust me.
politicians in Hollywood, boy, both not great.
Oh my goodness. Yeah. Okay. So God, where the hell do we even go from there? I'm so sorry, people. All right, let's talk about little sunshine and unicorn for a minute. I've never seen so many people chime in and say hello to you, Dan. I mean, not to you, but just in general. They don't all pipe in and go, "Hi, Dan. Hi, Dan."
Well,
Anyway, so
I'm excited to be with everybody, and if I have like a bigger smile on my face than usual, it's because I got some really good news that I'm comfortable sharing now, which is my wife and I are gonna have a baby end of February, and we just did the gender reveal 2 weeks ago, and it's a boy. So I'm very excited about that. I'm excited to be a dad, and my dream, to get a little emotional here, my dream is to be a hero to my son like my dad is to me. So,
oh,
Nice.
oh, that's
yeah.
so sweet.
That's always
My
cool.
God. Well, you
Mhm.
told me about this months ago, and then when this morning when I asked you about it, oh my God, your face. So cute, just pure joy. It's just wonderful, wonderful, wonderful. So, and you know that everybody is just in there plugging for your dad and
Yeah, we
just
appreciate it.
believing that he is going to be healthy and back at it. And I mean, he's already back at it. Good God, he
He
looks
didn't miss
great.
much. He's a savage. He
He
really
is amazing, like cracks me up. So anyway, yeah, it's all gonna be good. I'm excited for you and your family. It's good, good, good.
thank you.
All right. Where do we go
Well,
from here?
you know, I mean, I don't know what we can go in any direction you want to go in, but if you want at some point, I do have like some extensive work that we've done on where we think rates could go.
It
So
okay, Dan, let's do that. It is absolutely on my list, so why not just go there? And also, while you're at it, I also want to talk about where rates are going to go, but really this balance between when do we refinance people? I mean,
mm,
we're struggling. So I listen to the C-suite guys, and
mm,
they're just like righteous in their thoughts that if there's an EPO, of course the LO should pay for it because they've paid so much to get this loan and they've earned it and all this stuff. And I'm like, okay, those jerks get paychecks every week or
yeah, I
every
wouldn't do
week.
that.
Yeah.
We don't get a
No,
paycheck. We get a paycheck when we close a loan. And so for
And
me,
then it gets taken away when someone else closes it.
oh my
yeah,
God, it makes me crazy to listen to it because I'm like, you are so entitled.
yeah,
And
we're not working for free here, right?
yeah,
So,
well, we are working for
We
free.
are.
We close a loan, and then when we have an EPO, which we have no freaking control over, and especially if these servicers are going to be as aggressive as they're forecasted to be. So, yes, so by all means, let's talk about rates and how do we strategize this?
yeah, I have some forecasts on rates, what the opportunity I think would be, and then also some strategies around really maximizing the opportunity, right? So let
Great.
me just share my screen and just,
Oh, God
oh, I
damn.
think
Come
I
on.
just might need,
You got to tell me these things ahead of time.
my
Jeez.
fault, my fault.
Hang on, hang on. Okay, yes. Hallelujah. There you go. You should be good.
All right, perfect. So let's take a peek here. So one thing actually I just wanted to talk about because I think this could be helpful for some of the listeners. You guys are probably getting this because the media outlets are pushing it, right? But the Fed cut 50 basis points, and now what's the conception, right? Most people believe, oh, mortgage rates are 0.5% lower, baby. Let's go ahead and let's
Exactly.
get that savings.
Yep.
Obviously, that's not the case. The Fed
Yep.
did not cut mortgage rates; they cut the Fed funds rate, which is really the opposite of a long-term rate. It's a ultra short-term rate, an overnight rate banks use to lend to one another. But it does have a direct impact on like your short-term treasuries if you were smart and invested in money market accounts like everybody, right? Or most people, I know I did, or, you're getting over 5% in a liquid, almost risk-free type environment, that comes down immediately when the Fed cuts. And your short-term treasuries, your credit cards, your car loans, your small business and personal loans and stuff like that, those all come down. But long duration rates, 10-year mortgage rates, those can be indirectly related. But funny enough, there's been periods of time in the past where the Fed has cut rates and it's been perceived as being inflationary, and long rates have actually moved the wrong direction and moved
Mhm.
higher. So it depends on the scenario. I don't think this is one of those cases, although a lot of times it's not uncommon to see mortgage rates move a little bit in the wrong direction shortly after the cut and the 10-year and then continue the downtrend. But it really has to do with the perception on inflation, in my opinion, because that's the main driver of long duration rates. So, first off, the Fed said they're not going to cut rates until they were confident inflation's coming down, right? So they cut 50, they must be pretty darn confident inflation's going to hit their goal. And they're forecasting through their dots plot chart 50 more basis points this year, 100 more next year. So 150 basis points of cuts between the rest of this year and next year, 1.5%. And they think inflation is going to fall from 2.7% on the core PCE to 2.2%. So they think inflation is going to continue to go closer to their goal and then eventually hit it in 2026, all while they're cutting 1.5% this year and next year. So that, I think, is a strong signal to the market on inflation. Now, indirectly, how can this help too? Well, you have a scenario where you have people looking at their portfolios, investors, and it's like, okay, well, I just saw my money market account come down 0.5% with the Fed cut. They're going to cut another 1.5%. Before this thing starts evaporating quickly, let me search for some duration, right? So maybe let's buy some protection over 10 years. And while yields are still somewhat attractive on things, let's say like a 10-year, let's invest in that. And the increased demand there can cause price to go up and yield to come down. And that can actually help yields come down in an indirect fashion. So just a couple ideas there on that. But you want to obviously explain to customers that the Fed's not cutting mortgage rates, right? They're counting the Fed funds rate, but certainly they're taking their foot a little bit off the economic brakes. But remember, they hiked 5.25%. So the effective Fed funds rate was 5.375, right? It was in a range of 5.25 to 5.5. They cut 50, so now it's 4.875 or 4 7/8 in a range, right, of 4.75 to 5%. So this is something that they hiked so much, and inflation's at 2.7%. They're still very restrictive, even after the 50 basis point cut. So, you've heard some Fed members like Goolsbee talking about this, where he's like, we're not even close to the neutral rate yet. We have hundreds of basis points or percents that we could cut and still be restrictive. What they eventually want to get to is something called neutral, where you have the Fed funds rate at a level where you're not being stimulative and you're not being restrictive, but there are ways to go there. So I don't think the Fed, by cutting, even another 1.5%, is necessarily going to be inflationary, although someone could argue on the other side that, hey, now I'm going to be spending less on some of these other debts or shorter term loans that I have, and maybe that opens up some disposable income. But all in all, I'll show you what I think is going to happen with rates, okay? So the Fed's going to cut, let's say they already cut 50, maybe another 150 next year. They're going to cut 200 basis points. So based on that indirect relationship we talked about, I think it's very likely you could see the 10-year come down from its current level of, let's call it 3.75, 50 basis points to 3.25. And those of you that like charts and technical analysis, not a lot of floors of support before reaching that 3.25 level. If we get under, let's call it like 360, and it's actually some of the lows we saw back in March of 2023. So not even that long ago. Now, there's always a relative, it's easier to forecast kind of where the 10-year is going to go and then say, what's the relative relationship between the 10-year and mortgage rates? Because there is always a relative relationship. So there's a spread, a natural spread between the two, meaning mortgage rates are normally, if you look historically, in between these two green bars that I have outlined, meaning mortgage rates are normally, throughout history, 1.6 to 2% higher than the 10-year Treasury on a 30-year mortgage rate. But you can see there's periods of time where these spreads widen. They get blown out, where here mortgage rates are 3% higher than the 10-year, but then they come back down to the historical norms. You can see here, 280. In October of 2023, it was 3.1% higher than the 10-year, but that has now the spread been narrowing. So what causes these periods of time where you see the spread widen and mortgage rates are higher than normal above the 10-year? A lot of it has to do with like servicing values, because that is a value of the price of a mortgage. And when rates are 8% like they're in October, there's very little servicing value in the loan because they're really high rates. And a servicer, you either have a company that does servicing, like as a part, one of their arms of the company, or they buy the servicing rights, but then they make money by keeping it on their books. Well, we have 8% rates. It's expected rates are going to come down. There's a lot of prepayment risk, right? It's not estimated that that loan's going to stay on the books for a significant period of time for you to really make a lot of money. So very low servicing values, part of the reason why the spread widens. As rates come down, servicing values re-enter the picture because there's less of that prepayment risk as they come down. And on a comparative basis, you can actually see mortgage rates come down faster than the 10-year, and that's when the spread narrows. We're seeing that happen already. The spread went from 3.1 to about 2.5 right now. But I think that'll continue to narrow. So let's put this together. Target on the 10-year is 3.25. Could even happen later this year or maybe the first quarter of next year, in my opinion. Now, the spread narrows from 2.5 to 2.25. Where does that put 30-year mortgage rates? At 5.5%. I think that's actually very realistic. Now, just a little look at history here. if you look from what the 10-year does from the peak, meaning the highest point, to the first rate cut, looking back throughout history, normally it falls about 1.4%. Well, the peak was around 5% in October of 2023. Going into the Fed meeting, it was like 3.7. So 1.3, it's pretty close to 1.4. So that first part, pretty in line with like historical norms. So what happens after the first rate cut? Well, we just outlined what I think is going to happen in the shorter term, but how about longer term? Well, this is just looking at history. And, I like the Mark Twain quote, doesn't have to repeat itself, but oftentimes it rhymes. The 10-year normally falls 1.5% from the first cut to the low in the cycle. So starting at 3.7, that would bring the 10-year down to 2.2. Now, you could say that maybe that's a little too optimistic, but I'm just showing you the numbers historically of what could happen in the longer term. So what does that mean for like the refi opportunity out there, right? Well, and we talked about like the timing of this. Should you refi now? Should you wait? Things like that. So, just looking at the loans done from 2022 to 2024, because some people count the ones before that, but there's got to be hair on those deals if you didn't refi and could have previously. So let's just look at the vintage, these loans, right? Well, you right now have like 2 million loans that are in the money of loans done above 7% that you could refi right now. But if rates fall to like 6%, you unlock another 2 million. If they fall to 5.5, another 2 million. You got like 6 million ripe refinances that, of course, the purchases are important, but you can have like a double up type of year if you're able to maximize the opportunity with these refis and still focus on your purchases, but capture as many of these as you can. And a lot of people can benefit now. I mean, if you look at mortgage application data, boy, if you're not doing the refis, you're missing out on 56% of the business, because that's what percentage refis made of transactions just last week. Refis are up 175% on a year-over-year basis, which, albeit it's from low levels, but there's been a big
from
increase.
total crap down
Right.
to
Right.
100.
So here's like some guidance on like some of the things that we're recommending that you do. So, we saw this happen a month ago or so. The refi opportunity, like, it can be short-lived at times, right? It's a very volatile market. And, it's not a great idea to wait for rates to come down to where it might make sense for a customer to refi and then reach out at that point, right? I don't think it's the most efficient way. Now you're playing phone tag. So we really think that you should be obviously always staying in touch with your database, but reaching out to them, having a conversation before, and establishing what a strike rate would be, right? So what rate makes sense to refi? You're at 7%. If rates hit 6.25, I want to get a commitment for you that we don't have to even have this conversation. I can move forward and get a lock and get a pre-approval and things like that, right? So you want to almost like pre-sell this and then, sell the big numbers, right? So, hey, if we saved you the 3/4 in rate, we'd save you $350 a month. That's great. But that's $4,200 over the next year. That's $21,000 over the next 5 years. And a little tease here, coming out in the next like week or two, MBS Highway, we have a strike rate tool that we are releasing. You get it for free if you're an MBS Highway member. But we basically help you organize your database and make sure you're maximizing the opportunity. And we're going to send you alerts every day when you have customers that are hitting your thresholds for how much they need to save in rate based on the loan amount. You can, customize that and then show you what the estimated savings would be. So really help you to be efficient and maximize that opportunity. And then the last bit on this, Audrey, which you had mentioned smartly, is what happens if you get customers that get greedy, right? Like, obviously we want to wait. And by the way, to your point,
What if?
like, so you put in the EPO period, because we're not going to be doing these loans for free. If you're after the 6 months or so, then we're going to alert you, whatever period you put. But you have a customer that $400,000 loan, right? And the rate is 7%. We establish a strike rate at 6.25. Okay. So they're going to save $260 a month if we do this refinance. So it happens. Strike rate gets hit. But then the client says, well, Dan, what if rates keep coming down? I heard that the Fed's going to keep cutting. Maybe we could save another eighth in rate or something like that. Well, you have to quantify it for them. You have to quantify the risk. So, okay, right now we could save you $260 a month. If rates come down another eighth, that would be an additional $32 in savings per month. Of course, we'd want that, right? But how long is it going to take to get there? First of all, there's no guarantee that it continues to come down. As we outlined in the first half of this call, there's so many moving parts in the economy right now. But let's just say you're right. It comes down an eighth, but it takes 3 months to get there. Well, that's 3 months that you foregoed the $260 a month in savings. So you gave up $780 in savings to then start saving an additional $32. It's going to take you over 2 years to break even on that waiting that you did is the risk really worth the reward there? I don't think so. But not only that, hey, if rates do continue to trend lower, we could do this every 6 months, baby. And that's the way that I would kind of break it down and quantify these things for them. And we have another tool that we just released. This one's actually live on MBS Highway to help you quantify the refi opportunity versus the risk of waiting and why they shouldn't wait and they should take advantage of it right now. So I
Oh,
know that was a large mouthful there, but
that was a large mouthful. I love it. Like, yeah, you're gonna save enough to pay your Netflix bill if you wait, maybe, if you're lucky, if Iran doesn't really, step it up and everything doesn't really just go to garbage. So I just saw a slide and it said arms, and that is literally my next thing. So
hey,
let's talk
we're on
about
the same,
arms.
we're on the same page.
Aren't
Yeah,
we
let's talk
always,
about it.
Dan?
I think
Okay,
you
yeah.
guys are comparing notes beforehand.
We
We
didn't.
did. We did not. We didn't. I usually do, and we do not anymore. This is so au naturel that it's ridiculous. Okay. Walk us through yield spread, the inversion,
Yeah.
the where we are now, and the fact that we couldn't do arms, but maybe we'll be able to do them again, and maybe they will make sense.
Yes.
Go, Dan.
So the yield curve, it's normally in like a regular environment, a positive one. So what does that mean? Well, you have your 2-year yield as an example, and you have your 10-year yield. Logically, you would anticipate the longer you put your money away, 10 years versus 2 years, you get a higher rate of interest for that commitment of longer time. And that's normally how it works. 10-year yields are normally higher than 2-year yields. But we went through a period of time of like 780 days or something, right? Where
Who's counting?
the yield curve was inverted, meaning short-term yields like the 2-year was higher than the 10-year. Now that sounds like backwards, right? Or upside down or inverted, and that's why it's called an inverted yield curve. Now, because of what arms are priced off of, when you have like short-term yields higher than long-term yields, it can be hard to have attractive adjustable rate mortgage products. So the yield curve has started to now go positive and steepen, right? So it was actually, I think like 20 something basis points. I think the last look I looked, it was like positive 12 basis points. But remember our conversation that we had before about the Fed. So even though we think long-term yields are going to continue to come down, short-term yields are going to come down faster as the Fed cuts rates because there's that direct correlation. So the Fed's going to cut another 50 basis points this year. You'll see the yield curve steepen more. And we think that over time, you're going to see arms come back and have some more attractive arm products, which I think can unlock a lot of other opportunities for you that we're not even contemplating with just fixed rate mortgages. But with arms, you guys probably know better than me, customers can be afraid of them, right? So one of the things that we recommend doing is maybe change the way you talk about them. Instead of like an arm, maybe it's a hybrid fixed loan, but also sell the guaranteed benefit period. Because here's what people think. Oh, it's a 5-year arm. Well, that means that it's only better maybe or cheaper for the first 5 years, but mathematically it's guaranteed to be better for, let's say, 7 or 8 years. And if it's like a 7-year arm, it's like 9 or 10 years, right? But you have to do the math. But the chances of you being in the same home with the same mortgage for 10 years or longer is like 5 or 6 or 7%, right? If you just look at like national. So, it could be a viable option. You just got to kind of explain it to them, explain the guaranteed benefit period and some of the fear around that arm word.
Yeah, well, and also just a little reminder, we're not allowed to call them fixed arms anymore. You cannot use the F word at all when describing these hybrid arms. You have to really, you just have to keep it out of it. We covered it last year in our NMLS training. It's something that the regulators are finding in their
So
audit.
wait, you can't say that one more time for me?
Can't
Cannot use
say
the word
fixed
fixed.
term.
You
You
can't
can't
say it's
say
a hybrid fixed loan.
nope. You
Oh.
can't say you can't use
It's a hybrid arm.
word. You
Hybrid
cannot use
arm.
the
I
word
got you.
fixed. Yeah.
Can't
It's
use the word fixed at all. Okay.
No,
I
yeah.
didn't know that.
Yeah,
just
interesting.
remember, no F word.
Yeah, just remember no F word when describing an arm. So yeah, you have to stick with hybrid. It's stable. You pull out your little
Stable payments.
stable payments. Yeah. Anyway, so yeah, it's interesting though, because it'll give us excuse me, more options. I wonder it's been such a small percentage of the market for so long. I'm curious how many people really would find that attractive. So we'll see. Also wanted to throw this in there because I've had it on my list forever and I just want to retire it. If I've mentioned this before, forgive me, but I thought this was so interesting. It's worth saying again. Fannie Mae has added RSU, restricted stock options. Income is an eligible source of qualifying income. So now you can do RSUs with both Fannie and Freddie, which didn't used to be the
Wow.
case. It used to, we have to use to say that 3 times fast. We used to have to go jumbo or do some sort of alternate financing for that kind of thing. So anyway, just interesting to note, if you are hell-bent on using Fannie and Freddie as a resource, you can now use that RSU income. Okay, so let's just recap, Dan. Let's go back to this whole rate idea. So you think that by the end of 2024, that we are now in the fourth quarter, by the way, just to be clear. Can you
I know
believe
that's pretty wild.
it's still
This
8
year it just
million?
Christmas is
started
around the
flying.
corner.
8 million degrees outside, by the way, for the next week. We don't know why. I mean, there might be something about that global warming thing. We'll see. But anyway, it is fourth quarter. Hopefully you have your business plans done for Q4 so that you can finish this year up really well. I mean, we have every opportunity right now, right? So,
Well, the best time to do your business plan is October, because by the time you get it all in place, it's actually running on January 1st.
okay, yeah, Kevin, I'm talking about having a plan together for Q4. I mean, like you have your yearly plan, you got to reassess things, look at it. How's it going? Did you have your act together or not? If not,
Uh-huh.
pull it together and let's move it, shall we? So anyway, all right, Dan, I wanted to talk a little bit about the PCE report
Mhm.
that came out. That's the Fed's favorite measure. You've talked about it, just you've touched on it a couple of times. It was fairly in line with what they were expecting. And just going forward, as we're watching the inflation numbers and looking for, like what should we be expecting? Why don't you walk us through that just briefly?
Yeah, so we got PCE. I think it was like the 27th that we just most
Yep,
recently got it.
yep,
And
Friday.
here, you know what? I'll show you guys a little
What?
bit
You
like
have a slide?
I got, well, it's not even a slide. I'll let you in here behind the scenes at some of the crazy calculations and stuff that I do, but it's going to look a little complex here. But this is kind of how I break down some of this data in these reports, right? So this is the PCE, the most recent one that we had.
Yep,
And, it's broken down into all different segments, but, there's a couple different tabs I have because, you look at the dollars spent versus the overall expenditures and you get like the weighting. And then you have to do the weighting for both the headline number and the core number. And then you can see like how much each segment or each component is actually contributing to inflation on a monthly and year-over-year basis. So anyways, the bottom line is this. The headline number was in the media reported at like 2/10. That's the all-in inflation number. But the actual was like 0.155, so a little better than that actually. And year over year was actually it came down to like 2.3%. So, I think, or 2.2%. But the core reading, this might not be the most updated one I'm looking at here now, but the core reading, was 2.7. It was 2.6, but it went up to 2.7. But again, that was partially due to rounding. Powell forecasted it was going to be 2.7. But one of the things that I really look at is like it's not so much the year over year numbers right now because of the replacements, right? So when you're doing these year over year calculations on the PCE or the CPI, the number that's coming out from the previous year is important. If it's a low number, even if you have a good monthly reading, you could see year over year inflation go up because that number falls out. It gets replaced with this number.
Yep.
So what the Fed looks at is the year over year numbers. But one of the things they're really focused on is like, okay, what's the last 3-month run rate? What's the last 6-month run rate? Right. So, are we trending in the right direction? And the monthly reading annualized was like 1.5% core inflation. The last 3 months was like 1.7, and even the last 6 months, which had some higher readings in there. Boy, I think it was like a little bit above their goal, like 2.3 or something. So the numbers are looking good, definitely giving the Fed confidence. And this is all while shelter or housing costs, they're not really reflecting what's happening in the real world. And this is probably the biggest reason why that May 10th number didn't work out. I mean, everybody was expecting shelter costs to catch up by now. It's been years. And like we're still seeing shelter readings above 5% where it's not reflecting the real world. I mean, look at CoreLogic's blended rents. It's 2.8%. I mean, we know new rents are like negative 0.8% year over year. So, there's some error going on there where it's just not catching up. And because it makes up like 18% of core PCE and 46% of core CPI, of course, it's artificially keeping inflation higher than it would be otherwise. And I think the Fed's cognizant of this, but want to be clear. Sometimes it drives me nuts. People are like, oh yeah, well, inflation ended up being transitory, or inflation's come down so much. The rate of change has come down, but inflation wasn't transitory because all the price increases from the last several years are still there, right?
Yep.
Unless you see deflation, prices aren't coming down in aggregate. The price increases are all there. It's just now the continued rise in the price of goods and services is closer to the Fed's goal, which they find acceptable around 2%. So prices are still going up, and everything that happened the last few years is still there. So that's just an important kind of thing to note.
It is. Hamburgers are still $20 and they used to be 12. So yeah,
Yeah.
do the math on that. Okay, so Kevin and I get into arguments about this. So I would like you, well, both of us keep our mouths shut,
Okay.
to walk us through. Yeah, that's both of us, Kevin, not just you, me. Can you walk us through median home prices versus
Yes.
appreciation?
Yes. So, depends what you're looking for, right? I mean, the thing that a lot of times the media will do is they will talk about the median home price like it is appreciation, which it is not, right? So, appreciation is trying to say, what is the change in, let's say, the residential real estate value from last year to this year? How much has that home value gone up or down? Median home price is simply looking at the sales that occurred and giving you the median price, right? So if there was 10 homes sold from like 200 to 500,000, the middle priced one is your median home price. Now, sure, if home values are going up, potentially you could have median home prices rising. And if you compare them on a year-over-year basis, you will see it go up or down. But like, here's the thing. The mix of sales is the key driver here. So, if I had 5 homes that sold, to make it an easy example, in 2023, okay? And let's say the middle priced home is 300,000. Okay, that's the median home price. Now we know from 2023 to 2024 there was 6% appreciation, right? So the home appreciated, all those homes on average appreciated by 6%. But 2024 we saw less activity, especially on the high end. So now only the first 3 homes sold. Median home price drops from 300,000 to 250,000. So the median home price is negative on a year-over-year basis, but appreciation is positive 6%. So it can be misleading, and the media throws
It is
around.
totally misleading.
Yes, because it's just showing you the change of the median home price, not necessarily what happened with the value of those homes. Of course, if home values are going up over time, like that could cause the median home price to go up, or if they're going down, it can cause that. But home values have not declined on a nationwide basis, right? They've gone up 6% last year. They're
Oh,
on track
no,
for
the
about
media
5%.
said the median home price has gone down.
Well, the median home price has gone down, but not, maybe. Actually, I think the last I saw, median home prices were still a little higher. But yeah, I mean, median home
No,
prices
I
are going to
get
change a
this.
lot with the mix of
Yeah,
sales.
generally it means that the more people are buying bigger houses when the median goes up more than the
If
market.
you see the median going up, it's usually if you look at the breakdown of sales, there's usually a higher amount of sales on the high
Yeah,
end.
Lawrence Yun gave us the perfect story on this one. He goes, yeah, bigger homes are sold over the spring and summer. That's why you always see the median jump,
Yeah,
because
and
bigger
then
homes are sold at that time because people are looking to move when schools are out.
makes sense. Um, Guys, before we end it, I wanted to just show, and we could continue here for a couple minutes, but I had one thing before we end. I wanted to just show that's new, just
Oh,
to keep that
baby.
in the back of your mind.
So,
Is there anything else you want to cover before I do that?
No, go ahead. Well, you do that and then we'll wrap up. There's
Okay.
a few things that we're gonna,
So, we talked about the importance of staying in front of your database of customers and the refi opportunity that exists now and that is going to continue to exist and increase as rates continue to trend lower, not in a straight line, albeit. So, I showed you guys some of the stuff on MBS Highway, the strike rate tool, as well as the greed kills kind of tool, right? Why you shouldn't wait for rates to come down additionally if you could benefit now. But we also came out with something to really help you to stay top of mind with those customers, to make sure you're maximizing the opportunity. And you guys are all, I'm sure, familiar with HomeBot or Home IQ, great products, not a bad thing to say about them, but we've come out with our own kind of version, right? So, the numbers that I've found out there that are pretty interesting is like, you want to increase your production. I mean, if you're not marketing to people that you do business with, your chances of them coming back on their own is like 19%. If you market to them even with garbage consistently, it doubles. If you market to them with something of value, it triples, and that's really the key. So we've created something called the Home Report, where, listen, the feature set compared to some of the other tools out there, we have some things others don't. They might have some things we don't. think the bottom line is this isn't a tool that you're utilizing. This is a tool that we just want to make sure we're engaging the customer on a regular basis and staying top of mind and sending them something that they're interested in. Obviously, people interested in what's happening with the value of their home every month. It's probably the largest investment. So it looks beautiful. We give you a look at what you purchased the home for, what it's worth today, how you've done on your investment. And then we have, unlike anybody out there, the forecasted appreciation. So we could show you what that home is expected to be worth, maybe help you identify when you might be able to remove MI or cash out or different opportunities. We show you what you could do with the equity in your home, give you ideas. Everything goes back to the loan officer. We let you look up all the listings in your local zip codes, give you market stats for them, try to tease move up buyer opportunities, have things like a savings calculator. You can share it, and people can kind of help you grow your database by sharing it with their friends, and then they can get their own home reports. So the bottom line is this is going to be our new home report tool. Really, because it's not our only product, I think you'll find it's at a fraction of the cost of some of the other ones out there. And one thing that we don't do is, because of our pairing model we have with list reports, if you want to co-brand with your agents, they don't have to pay anything. So it's always free to them, removes that barrier. But they can't get it on their own like you can on some of these other services. I know some people weren't too happy when some of the competing services started selling to realtors at a cheaper price than LOs. On ours, you have to have a co-branded relationship with an LO to get it as a realtor. We don't sell to them individually. But Audrey, I've never done this before, but I had Diana, who I know you know, put this together for me where, wanted to just have a landing page because of the relationship with you guys with like some special just, discounted pricing because of Audrey and Kevin. So, people could come in here and either scan the QR code or just type in this address, and then you could sign up if you wanted to. We'd love to have you on the team for MBS Highway at a significant discount, or list reports, or that new home report tool that I was discussing.
So Dan, do you have an idea about, so, if, let's say I use HomeBot at this point, and I wanted to transition my clients from that to this, is there a seamless way to do that? Like, how does that work?
Yeah. So there's a couple different ways. Like, one easy way is you just do like a CSV or Excel file and upload it right into our system, and then we'll start sending it out for you. Another thing is that we
But
have all
is
the
there some messaging for my clients that would be effective where it's like, okay, we're going to replace this, or, with this, or how do I message that so that people understand that they're not losing what they had necessarily, they're just gaining something better?
maybe that's something we can craft up. It's not something I have, but it's not a bad idea, right? To help explain, but essentially that, still providing you with valuable information on your
Yeah.
property every month, but also, want to try to give you some additional, maybe insights, that might be more effective or more accurate.
I would love that, because I would be very interested in this. My concern is, how do I let my clients know and get them switched over?
Mhm.
So if you had any brilliant ideas around that, or any ideas at all, since I have none, I would love it. So yeah, so why
Yeah.
don't
But then
we,
we also have all the transactions, right? So with list reports, with our agent intel and stuff like that that we offer, we have all the transactions on the LO and agent side. So we really can help you to, you can mass upload your contacts, but then
yeah,
we know all your transactions, so we can suggest ones as you're closing loans. Hey, do you want to add them to your home report and things like
yeah,
that too?
yep. Yeah, interesting. I'm interested, so I'll circle back later. Okay, as we wrap up, so I don't usually do this, but I'm going to this time because one of our favorite people, Dirk Nelson, has reminded me that there is a celebration of life for Donna Bledsoe Brown. I don't know if you knew Donna. I remember her from way, way back in the day. So Dirk has posted this on his LinkedIn and Facebook, so you can get the details. I believe it's in Rio Vista. And I think it's this weekend. But anyway, as we lose some really great people in this business, it's worth taking a moment to honor them and to think about their contribution and what we are, what a loss it is. So anyway, if you have any questions, reach out to Dirk on that. And let's see what else we have. So okay, so there's a lot of questions around all this. So what is who should they email if they have questions about how to sign up? Dan?
Oh,
Great.
Um,
Yeah, back to
so
you.
to sign up, they just
Go
they
on
just
the
they
QR
just
code.
they just can scan this, or type in this address, or always, if you have questions, just Christine@mbshighway.com.
There you go.
I
Okay.
don't know if there's a way to share this, Audrey, with
And we'll embed that email
okay.
address, et cetera. Oh, you know what? Oh, geez Louise. Hang on.
But
Let me,
also, I saw somebody asking some questions on MBS Highway.
yep,
MBS Highway, we have a video that Barry and myself and our team does every single morning that kind of is like a little bit of a truncated version of a lot of the stuff we went over as news is breaking in
Yep.
real time every day. We
yep.
send you texts and alerts to help you manage your pipeline and tell you when to float or lock. We give you real estate data and all kinds of tools to help you with agents, but also in any scenario, whether it's like the cost of waiting or buy
Right.
versus rent or loan comparisons, anything you could do on, some other competitors out there. We do all that and much, much more from a loan comparison standpoint, debt consolidation, you name it. A lot of stuff in MBS Highway. No long-term contract. Check it out for a month. I think it's a no-brainer for you. You'll get a significant return on your investment.
Great. That sounds great. And remember, guys, we have a YouTube channel, Mortgage Pros 411. You'll be able to revisit every little pearl that fell out of Dan's mouth today, and any other videos that we have posted there. The only thing we don't put up there is the CFPB. Otherwise, it's a little treasure trove of information.
Yeah, and subscribe.
Yeah.
Quite a few
Sure you
subscribers now.
subscribe. Yep. And thank our good friend Jason.
You get a notice as soon as we post up.
Yes. Okay. Jason Bellevue, he does that for us. I just want to make sure that I say his name without it being covered up by anything else. So with that being said, Dan, thank you so much. We love you, and give your dad a kiss for me. And I will look forward to seeing you again next time. And I hope a lot of people sign up for these services. And we really appreciate everything that you and your family and the whole crew at MBS Highway do for us in the industry. And go get loans,
Well,
people.
guys, thank you. It's always fun to do these with you guys. So thank you, and thank you everybody for a lot of the nice wishes and comments. I appreciate you. Take care.
We love it.
Take care.
Have a great week,
Bye,
guys.
guys.